in the mainstream, we typically think that you buy a house, you put 20% down, you go to the bank, you get a loan. Yeah, many people buy homes that way. Absolutely. But there's a lot of other different ways to purchase homes. And so today we're going to be talking about some of those creative ways to help you make your money last better and get better deals for you as a buyer, because right now is a great time to buy. You'll see that my guest and I agree on that 100%.
Welcome to the Jeff Sutherlin Show. Let's grow today as we learn from decades of real estate and leadership experience.
We want you to know that when you log into this show, you're going to get authentic conversation. We're going to give it to you straight, and it's going to be real. Hey everybody, Jeff Sutherlin with the Jeff Sutherlin Show. Today, I have an awesome guest for you. He's coming out of San Diego. He's a mortgage broker, and this guy's been in the business since the 80s. This guy knows so much about mortgages. Before we talk to Kevin, I want to talk a little bit about what's going on in the market here. As you know, I track the market daily, and you can see there's about 17 main cities around the Phoenix Valley, about 17. And most of those now are falling into either a balanced market or a buyer's market. About 2 or 3 months ago, many of them were in sellers markets. And now we're seeing the movement, which is exactly what I projected to happen over the summer. Real estate in Phoenix is very seasonal, and the sales volume typically goes down in the summer. So what's happening is we have a ton of supply that's hit the market in Phoenix, a gob of it. And we have a lot of concessions happening from sellers, a lot of price reductions. New home builders are giving extremely good deals right now. The market now is getting very ripe to buy. And as we go through the summer, I expect it to get even better. So that's what's going on. If you have any questions, call us, because my business partner and I, Chase and myself, will walk you through all the different options you have. So that's what's happening in Phoenix. After 25 years of doing this business, I'm psyched about what's happening. And today, we get to listen to Kevin Prince. What a great gentleman, as I've gotten to know him. And he's out of San Diego. So how's it going, Kevin? Welcome to the show.
Thanks, man. How are you?
It is so good to have you here, man.
Yeah, I'm looking forward to it. You know, I love Zonies to come out to San Diego, right? Because and we know they're here. They you know, half the people in San Diego right now are from Arizona. So
half? Wow.
Well, you know, it seems like half. It's probably not that, but you know, we always say, "Welcome to San Diego. Now, please go home."
Yeah. I love San Diego. I love it there. I spent a lot of time on ships there when I was in the Navy.
Oh, yeah. Okay. Yeah.
So, you know, we're going to get right after it, Kevin. And then as we go, we're going to learn more about you and what you bring to the table, and just learn more about how buyers can get into houses. But, you know, everybody's always asking us, Kevin, I'm sure you get this all the time, what's going to happen with mortgage rates? What's your insight on that, Kevin?
Well, the insight for me is that it's really a big question, and everybody asks it. Well, I can't predict the exact timing. What I can say is that mortgage rates are really influenced by broader economic factors. And I'll give you a great example of that. This last week, the Federal Reserve Board met, and their idea was to, what is in the landscape? Should we lower the interest rates or not? And they didn't lower the interest rates at all, which some people predict that they would. Now, there's another prediction of them to lower the interest rates over the next, there's 2 different times that they'll do that throughout 2025. But we look at the landscape of the folks making the decisions to lower the interest rates, and you would think that they would. And so we look at the economic factors going, okay, wait a second. If they didn't do it now, why aren't they doing it? It's a very good question. And the short answer is there's a power struggle going on. I can't say it any other way. And if you look at that, we can't control that. That's just like, okay, here's posturing. Now we have a new president, and, I'm not going to say his name, but it sounds like Trump. Right? No. So you have, right? You have the higher powers going, hey, when's the interest rates coming down? When's the interest rates coming down? And the purse string guys, we'll just call them the purse string guys. We'll call them, the Federal Reserve Board and their policies are like, wait a second. I'm just going to say this, and that might create some feathers, but we're not going to get pushed around So we're going to stand our ground on it because there's too much volatility going on in our economic world, in the world period, right? So when you have that, the safe way to do it is to not do anything, to keep it status quo. And when we do that, then all of a sudden, now we're like, wait, what? I thought that the rates were going to be going down. No, they're not. And so we have this tussle. Historically, rates fluctuate like today. If someone wants an interest rate, and let's just keep it, let's say 7%. Someone wants a 7% interest rate. Well, tomorrow, actually, the markets close on Saturdays and Sundays, but during the week, the interest rate is going to be different. So every day the interest rate can change. That's why there's a lot of flexibility. There's a lot of flexibility. Maybe that's a new word, but there's a lot of fluctuation going on, right? Flexibility. I love that. Can I sniggle at
Yes,
that?
you can.
I want to sniggle at that. And you can use that, guys. Flexibility is it's important as a prospective buyer to focus on the long-term goals rather than, trying to understand the market, because you're not going to figure it out. And I've been doing this for 40 some odd years, right? I started when I was 5 years old. So, I never figured it out, but I did when I started. The interest rates were 16.5% back in 1983. Think about that. 6.5%, 16.5%. And we're complaining that interest rates are 6 and 7% now, but we have to look at an overall picture. Long story short is, when will the interest rates decrease? Very good question. They will, but they'll also go up, and then they'll decrease and they'll go up. The breathing of the market is what it is. What we want to do is we want to understand what we can do and how we can gauge the interest rate structure, interest rate around us, so that we can take advantage of it when we possibly can. And there's a lot of interesting things you can do with interest rates. For example, you can do a buy down, and a buy down is simply you're paying up front for an interest rate, and you're actually buying down the rate. It's not an adjustable rate. It's a buy down of your fixed rate mortgage. If you pay 1% extra, you can buy that rate down. Let's say it's 7%. You can buy it down to 6%. All of a sudden, you're at affordability. And
That's right.
sellers can buy that down, and that's a fixed rate. What a great idea. You can do it 2% or 3%. And now all of a sudden you have a fixed rate at 7%, but you're buying it down 3%. And we can talk about the buy downs and how those work, but essentially it is a temporary buy down, and we can't get crazy on it. We could get crazy on it because you can buy it down tremendously. But now the affordability index is there for our buyers.
Yeah. Absolutely. We're seeing a lot of that right now with builders buying down rates for buyers. And now on resale contracts, buyers coming in and asking the sellers for concessions and using some of that money to help buy down the rate. So, when you look at this as a consumer, you're like, oh my goodness, it's 6.8 for interest rate. Not necessarily. So that's where it pays to have a good lender. It pays to have a good agent, so we can go in there and negotiate on your behalf.
Yeah.
Kevin, when we look at your career, you've been in this for 40 some years. I mean, that is amazing longevity. Yeah. So kudos to you for that already. But how have things changed over the years? When you look at lending, I bet you've seen a lot of changes in that industry.
Oh, it's tremendous changes. Here's what I can say about change for the industry or for the real estate landscape. It's always on an upward cycle when it comes to homeownership. And I'll give you an example. People say, well, I don't know if it's the right time for me to buy now. And it's always the right time to buy now. And it doesn't matter. I'm just going to say this up front. It doesn't matter what the interest rates are doing in a long-term basis. It is about, when I started and interest rates were almost 17%, people were buying homes and interest rates would come down, right? And come down, and they've come down tremendously from there. You see the landscape and you have to figure out, okay, I need to be educated. So that's the first thing you want to do as a buyer and as a seller. You want to be educated, right? And a lot of times you can't get that education from someone other than a professional like you, Jeff, who knows who can educate someone, and then you can bring in the experts that will really help your folks do a better job of understanding what's going on. Now, we don't expect everybody to be, educated beyond what they know, meaning that you don't need to know economics to understand if you buy now, in 2 years, it's going to be worth 10% more. That's easy because that's what it will be. And it transcends all market shares because everything is an upward mobility, if you will.
Yeah, and I think the only time where I could honestly say is not a good time to buy now, but it rarely happens, is when you're in a declining market and you can see the prices sliding and you know that you're going to sell like within 2 years. I've seen people get burned in that situation where they have to short sell their house, things like that. So if you're not sure you're in that home for a while and you're very mobile and you may not stay for a while and there's a lot of volatility in the market, that's the only time where I think I've at times coached buyers to let's take a pause here. If you're going to leave the state in a year or a year and a half, it might be best to wait.
Yeah, no, I agree with that. But there again, there's opportunity in those because all of a sudden, if the market's going down and everyone sees it and you can actually acquire a property for even under that market because everyone sees it, a wise man said, hey, when the building is burning, right, you either run away, right, or you go in and you help the people out. And that's exactly what we need to do. So we need to look at it in a different way. Warren Buffett said that, right? And Warren Buffett did okay.
He did okay.
He did okay. He did pretty good. He's a multi-gazillionaire, right? And another sniglet that people can use. But so we look at these opportunities and we go, okay, well, even if that's the case, if you're buying it right, then even in a declining market, you're going to do well.
So Kevin, you're a mortgage broker, and can you explain to our audience the difference between the broker and the banker? And then what value do you bring? Because I'd love for you to share some of these unique products that you know of that most consumers don't even know exist.
Yeah, that's a good point. See, banks are traditional lenders that have their own loan products, their own portfolio, right? And often with a lot more stringent criteria. And so you have to have good credit. You've got to have good income. You've got to have good this and that and the other thing. And you got to pull your credit. And all of a sudden, if you don't hit all those metrics, banks are very difficult to work with in those genres. But some people, 10% people, 10, maybe 15% of the people can actually do that. Mortgage brokers act as intermediaries. Intermediaries we're shopping multiple lenders to find the best fit for our clients. It's just like a mortgage. It's just like an insurance broker, right? Insurance broker is going to go out and they're going to find the best available for what they have, right? Then the borrower is often benefited by the mortgage broker, and because we have a greater access to broader range of options and competitive rates. Then we actually I can say good, better, better, a good, better, best. I can say, okay, here's your options. You've got this, and we can go to US Bank, or we can go to a company maybe like United Wholesale Mortgage, which is a wholesale mortgage company. They're the largest lender in the nation. And it just so happens that UWM stands out for me because their innovative platform helps me be able to do a pre-underwrite for folks, meaning that I can help you qualify for a loan very quickly. And my closing ratio is much better. And I can close loans, get this, in 10 days.
Whoa. How do you do that?
That's unheard of. It is unheard of, but I've done it. I've closed loans in 2 days. And now that is anomaly. That is not your typical, but from start to finish, if you do it properly, understand the metrics on how and in which to do it, a large partner like, United Wholesale Mortgage or the like, with someone that has good information and can understand how to do it, you can close very quickly on a real estate transaction. And Jeff, you know that if you have that ability, you're going to win more deals on a daily basis because you have the ability to be able to do that. So they prioritize speed, transparency, customer service, and UWM provides mortgage brokers like small guys like me the tools that we need to serve our clients effectively and efficiently. United Wholesale Mortgage has it is the number one lender in the nation with a 33% share of the market. One company, that's amazing. But you have to, in order to get to United Wholesale Mortgage, you have to use a mortgage broker like myself. And that's for a reason. So my company is called the Financial Partners, and we're a private money lender. And a private money lender just means that we don't have to go to an institution to get our money. What we do, and it's very unique in that we'll get someone that wants to invest their money in real estate trustees. They become the lender. And then as we do it, we can think outside the box. And we think outside the box, then someone with, I believe it or not, this is a true story. One of the last loans I closed, borrower usually borrowers need a 700 credit score. You talk about credit scores and FICOs and all these acronyms that you talk about. The borrower had a 477 credit score, 77, and we got him a loan.
Wow. See, that's something that nobody would even think of. People mostly think they got to have in the 600s to get a house.
Yeah. No, that's absolutely right. And that's why private money, and some people call it hard money or equity loans, right? Hard money in back in the day just means hard cash. That's what it meant, right? So these lenders had hard cash, and they would just go, okay, well, I'm going to lend on this property and you got to pay me back. I become the bank. And that's what hard money is. And there's three different buckets, if you will, for that kind of arena. And I think we talked about this a little bit prior too, but you have the sharks, which are the hard money guys, right? We'll call them sharks, right? Because they want high points, high fees. They just want to get their money out. They're working for them, and they're going to help folks buy or refinance or do seconds or things like that. Those are the hard money guys. We'll call them sharks. And then you have the fish, which are like the conventional lenders, which they want to refinance. They're low interest rates. They're way harder to kind of work with. And we're right in the middle. We're private lenders. So we're like Dolphin. And Dolphin is there, right? We want to help people. We get rid of sharks because we don't like the sharks. Sharks eat our fish, right? Sharks, run around and they destroy the industry. I mean, I'm sorry, if you're a shark out there, I'm coming for you, right? I mean, I want to get rid of you guys because we don't want transactional deals. We want relational deals. And what that means is that you have a lender for life, right? You have Jeff as your go-to guy, and that's about relationship as opposed to transactional deals. Now, sometimes, and we can talk on and on about that, but as a private money lender, we put mom and pop's money and back up a trust deed. You put 30% down. You go buy this place. Your interest rate's going to be higher, yes, but your credit score was 477, and we don't care. Isn't that interesting? And most people have no clue about it. They just do not understand how this works, and that's why this kind of environment is super important to be able to articulate that. And then now, as somebody who says, I can't do it because ... now you've opened up a lot more opportunities to do that. The other thing that I love about United Wholesale Mortgage is they have 100% loan to value loans, and you don't have to be a veteran. Let me say it again. 100% loans. You don't have to be a veteran. What? That is leverage to the max. Now you have to have good credit. You have to have good income. You have to be in certain environments, but 100% loan to value? Are you kidding me? You just have to come in with your closing cost? That's amazing. That's like unheard of. Now, typically, if you do 3% down, that's amazing. But you can do 3% with FHA, which is Federal Housing Administration. You can do VA with no money down, but they also have conventional loans where you can do with no money down. And then there's DPAs, which are down payment assistance programs and other things like that you can bring to the equation. What the landscape these days is trying to do is make it so that people will open up the door for home ownership. And that is your best investment of your life. And that's a guarantee.
So let me unpack this for the listeners. You're saying, Kevin, that if somebody comes in and they have a low FICO score and they're losing hope, right? They could literally call you, and there's probably somebody out there that would invest in that loan and back them. And it might be a higher rate, right? They might have to put more money down. There's different variables, right? But the point here, I think I'm hearing from you is that you don't know until you know, and you need to call somebody like yourself so you can see the different programs that exist out there, no matter where you stand financially.
Yeah. It's important to get pre-qualified, right? If you have a check in your pocket, and let's just keep it simple. Let's say you're buying a place for $100,000. We know that that's not the case, but let's say it's $100,000, and you go to a guy like me, and you say, Kevin, can you help me pre-qualify for this loan? We in turn will pre-qualify you and pre-write that $100,000 check for you and give it to you, and you put it in your pocket, and then you take it to Jeff and go, Jeff, can you help me can you represent me with this $100,000 that we're going to buy this property with? And Jeff will say, absolutely, 100%. As opposed to, well, we're just going to shoot in the dark and try to figure it out and see what happens. And maybe it'll work, maybe it won't, but who knows? No, be intentional. I think that's the right word. Be intentional about it. Get pre-qualified for your home ownership. And when you do, you'll have tremendous success at writing offers that will be accepted because you're pre-approved. There's a difference between pre-qualified. There's a difference between pre-approval, and then there's a difference between approval, final approval, and so on. What you want to get is you want to get pre-approved. Pre-approved means that, hey, we've taken a look at your income, we've taken a look at your credit, we've taken a look at your ability to repay. Those are the 3 C's we call credit, collateral, capacity. And when we can see those and jump those hurdles already over, guess what? You can go in, make an offer, and your loan will go, boom, done. Let's close. As opposed to, what happened? Oh no, the credit score came in too low. And then people are freaking out, and then everybody's calling you because real estate transactions, probably that I mean, Jeff, you know this, real estate transactions are not just you and your real estate agent and a couple other people. I mean, it involves a lot of stuff because you have buyer's agent, seller's agent, escrow, title, appraisal, lender, and then that's just one set. And then you have the other people who are buying something else that you're buying their house, and all of a sudden it just gets convoluted. And pretty soon you're like, what in the world? So you want to know what's going on and have as much information. That's why these podcasts are so important, because you want to know what's going on and be able to control. I'm just going to say this: you control your environment so that now you can be confident about making an offer to a seller, and they would in fact be confident as well. Does that kind of make sense?
Absolutely. And you brought up the difference between a pre-qual and a pre-approval. Man, I totally agree, because what the difference is, and correct me if I'm wrong, is a pre-qual is basically one lender saying, yes, I've done a brief interview with the buyer and they are qualified to purchase this amount, but it's not been run through underwriting. It's not been checked by other people. And then you have the pre-approval, which I love those much better. And those have been run through desktop underwriting or something of that sort, right? That way we know that this is a pretty secure approval. And one thing I will say is I've tried to partner with lenders over the years that if they say they can allow the buyer to write on a certain price, I want to know that it's locked in. I'd rather have a conservative lender. If all they can give me is a pre-qual, I'd like to be sure that they've done their due diligence. So there's definitely a difference there.
Yeah, there is. And it depends on who's doing it. I'll give you an example. As a lender, I can just talk to somebody and go, yeah, they qualify. I can write up a letter and, give it. I'm just saying, we can do that. But what you want to do is you want to understand the difference between a pre-approval and a pre-qualification. Once again, pre-qualification is, based on that, what's your credit score? Well, I think it's about 700. I'm not sure. Well, let's find out. You can pull your credit report every year, every year free. Did you know that? You can pull your credit report every year for free, and it doesn't ding your credit. They said, well, it's a soft pull. Oh, it's a hard pull. It's all these pulls. And you're like, what in the world is going on? What's a pull? Well, that means when someone pulls your credit, They're going to say, well, it's a soft pull. I will debunk this. There's no soft pull. There's no hard pull. It is a credit report pull. I'm so old school that I went to Fair Isaac and actually sat with the bean counters. And we love Fair Isaac. Hi, Fair Isaac. But I sat with the bean counters and I started to understand how they were doing their credit scores. And I was like, wow, that's amazing. So you have to understand a little bit about that. Educate yourself on your credit score and then get pre-approved. Once you're pre-approved and you can find someone that you love to work with, find someone that you trust, because it's about relationship as opposed to someone that is trying to slick you into the deal. So relationally is more important than the low interest rate, because the low interest rate, guys, I can quote you anything and tomorrow it's going to be different. So you have to look at who you trust. Does that make sense?
Yeah, this is great stuff for our audience. Can you explain a little bit more? Let's go back to what you said earlier. How can people get a free credit report? And can you explain the difference between a soft pull and a hard pull? Those are industry terms. I want people to understand what you meant by that.
Sure. Industry talking about pulling credit it's very fascinating because there's a lot of misinformation. And we're just like freaked out because, all of a sudden my credit score says one thing and someone pulls it over here and it's completely different. Let me back up just a little bit and talk about the credit industry. The credit industry is, I'm just going to say this, they make money. Man, they make money. They make money. And you know who they make money on? They make money on you and me. Now, let me ask you a question, Jeff. Did you ever sign things stating that TransUnion, Equifax, or Experian would ever get your personal information? Did you ever sign anything about that?
I believe I have, yes.
Well, you didn't.
I didn't. Okay,
No,
I didn't.
No, you've never signed. You've never said, hey, you can have my credit information. We've never done that. I mean, now we'll sign a loan application, right? And we give them our credit card over the phone, and so first off, we have to understand that this is a really unusual and very interesting business. And I'm kind of pulling back the Wizard of Oz layer. I don't even know how to say it, but here's and I can go into craziness going on, and this is not the conspiracy theory thing. What it is that credit reporting is a very unusual industry. And the credit report that you get for consumer is different than for insurance, is different so you have different credit scoring. Fair Isaac is smart in that they will tailor their credit scores or their scores to different models. One is consumer for credit cards. Second is insurance for the insurance industry, so that they can gauge if someone's going to be a good risk or not. Mortgages. An RMCR is a residential mortgage credit report, and we go on 3 credit scores. So we'll do the TransUnion, the Equifax, and the Experian. Those are the 3 credit reporting agencies. And as you talked about, you can actually have your credit report pulled. You can pull your credit report from freecreditreport.com or Credit Karma or one of these online bots. Just be careful that you don't put your information into someone that you don't vet out. So be careful of putting your social security number online, because you never know. You just never know. And if someone asks you your credit score or credit report, I'll back that up. If someone asks you your social security number, here's the answer that you give anyone that asks for your social security number online or on the phone. I'm not going to give you that information, right? Say it. Absolutely say it. Most lenders that are reputable are going to, and licensed lenders like I am, will take that to their grave, right? Because your credit report based on your social security number is super important. They need basically three things to pull your credit: your social security number, your date of birth, and making sure that it's you with your address and that kind of thing. And you can actually pull your own credit report directly from TransUnion, Equifax, or Experian, but you initiate it. And when you can initiate it, then there's a security that is heightened when you do that. And when you pull those credit reports, interestingly enough, it's a misnomer, because if you want your RMCR, residential mortgage credit report credit score, you're not going to get that. You're going to get a credit report that will be for consumer purposes. Your credit score will be different. So we could talk about that. That's a whole nother topic. You and I could sit down and I can show people how to get their credit score from a 500 to an 800. That's another podcast for another day.
That'd be fascinating to learn from you on that. So my question on what you just said was, if I go out, let's say, and apply for a mortgage, and I also know I need to go get insurance, those companies are going to pull my credit. And are you saying, Kevin, that the FICO score would be different to each of those companies? Because there's... No kidding. See, that in itself, I bet 99% of the people listening didn't know that.
Nobody
or maybe
knows.
It's just me.
Yeah, people were like, what in the world? Well, my credit score is this. I'm like, well, okay, but your credit score is different for different industries. How about that? And you know why they do that? I'll give you the reason why they do that. To make money. Dude, they're making money on us, right? And they're selling this information. When one of my customers pulls their credit, I get a notification from my lender that says, hey, they're shopping. And you're going to get these calls, right, from people that are just random willy-nilly. And all of a sudden, so we can go on and on about that, but this is very interesting. And here's the bottom line when you're looking at that, Jeff, you as a consumer, us as consumers, just want to understand it. And it's important to understand it. And if we can understand it, then we can make better decisions. Education is super important. It is the key to keeping your credit score up or to increase your credit score. And if you have a challenge with your credit, I'd love to talk to people offline. I'll help you get through that so that you can actually leverage well because the better credit score that you have, if you're using credit, better score that you have, the lower the interest rates you're going to be able to get.
This has been amazing. We're talking to Kevin Prince, mortgage broker out of San Diego. What a wealth of information that today, back to our original question, we were talking about, hey, it's now a good time to buy. I think people also forget to realize is if they buy at a 6.8 interest rate, and let's say the interest rates do go down, we don't know if they will, but if they do and they jump down into the even the fives, the mid fives, can't they just refi later? Kevin?
Yeah, they can. Here's a word of caution for that. Yes, they absolutely can. But every time you refinance, it costs. It's going to. So you have to weigh out the differences of the cost versus the benefit, right? So if you're at 6.8, you like the 6.8% interest rate, and the interest rates go on eighths. So it would be 6.875. That's how interest rates are kind of, they are traded. And interest rates, when you do a mortgage, those are sold, most of them, to mortgage-backed securities. And when you sell them to mortgage-backed securities, it is on eighths. So 6.875 would cost you this today, but tomorrow maybe it's 6.625, which is 6 5/8, so on. The bottom line here is that if you choose to buy now, you're fixed. And I always recommend a fixed rate. You can go adjustable, absolutely go adjustable, but the majority of the time, a fixed rate is more conservative. And I'm more conservative in my estimations for folks. So at 6.875 or 7%, now 2 years down the road, interest rates go down to 5%. And that's what we're hoping. When you have downward pressure on interest rates, it's important to understand, excuse me, the logistics of it. Now, let's go macro. If you had a credit card, Jeff, and your interest rate was 20%, but you controlled the interest rate, would you want to pay lower on your interest rate that you controlled?
Yes.
Good question. So the question is, you had a credit card, right? Your credit card is Jeff's credit card, and you controlled that interest rate. And it's 20%. Would you want to pay lower on your interest rate, right? And the answer to that is, of course.
Yeah.
So the propensity of you to lower your own interest rate is to your advantage, right? And that's where we have with the Federal Reserve. They are increasing the interest rates, right? for hedging inflation or whatever the excuse is, right? But it's very interesting that they control that. What? They actually control the rate. And there's a lot more to it because interest rates,
Yeah.
I won't get into it this time. That's a whole nother conversation. What it boils down to is the market breathes up and down, and the interest rates are for us to understand, but we can't really understand them too well. Here's what you can do as a consumer. Look at the gas prices. Gas prices and interest rates go hand in hand. It's so weird. It's the weirdest thing I've ever seen. But remember in the 1979, 79, this is a Carter years, interest rates were low and then interest rates shot up. So did gas prices, and they went hand in hand. And so if you look at it over the life, this is simple, and this is not all the time because there's other factors involved, but it's very, very eerie to see what interest rates do in connection with gas prices. So if the feds now have a plan to lower gas prices by increasing production, your interest rates are going to follow suit. Cool, isn't it?
Yeah,
I mean, you see that's a trend. Now, it's not an exact science, but it's a trend. And you're like, okay, that's cool. I went to Costco the other day and gas price running $4 a gallon. That's for me in Southern California. That's awesome. But for you in Arizona, that's what in the world are you paying $5 a gallon for? You're crazy, right? And all over the industry and all over where we are, but you see gas prices and interest rates kind of go hand in hand. And those are interesting. Those are just things that you go, that's interesting. Or if you're buying, then you can find a trusted mortgage professional that's licensed, that has an NMLS license, that's been in it for a long time. I mean, even if they're in it for a couple years, they're well worth your opportunity to invest the time to get to know a good lender. And I would recommend, some people are great for banks because they have a lot of money and they could put them in the banks and so on. What I would find is I would find what fits for you. A lot of times a mortgage broker would fit the very best because they can bring in what you need. And then if you're buying at 7% today, absolutely. In 2 years, the interest rates are at 5%. Boom. Refinance. The goal is to save 1%. If you can save 1% on your interest rate, that's generally a good deal to go with. Now you want to look at, okay, do they cost money? Who makes the money? And no one does it for free. No one. Right. And so, but there's like, oh, no closing costs. No this, no that. You're like, okay, wait, what's the shell game? What in the world's going on? And so, excuse me, you have this really interesting thing because people will tell you whatever they want to hear. And a lot of times if you're shopping rates, they'll say, oh yeah, we can get you 6%. No problem. And then you start the paperwork, get it ready to go. You put it in there. They're all set to go. And then you put it all in there and they go, oh, that was yesterday. We can't get that for you today. It's 6.5%. You still want to go for it? Like, what just happened there? Right. So so what you boil down to in that case, Jeff, is that you boil down to people that you trust, people that you know, or people that you can get a referral from or for. Right. This guy did a good job. So, and always go with your realtor's recommendations. And a good realtor is going to give you a couple different recommendations. Hey, if you want a VA loan, try these people. If you want a conventional loan, hey, you might want to try these people. And now you have an alternative to try Kevin Prince, who does private money lending. Or we can do out-of-the-box financing. We can do reverse mortgages like we talked about before to buy a home. What? You're kidding me. Yeah, reverse mortgage, no payments. No, that's crazy.
That's the thing, right? You hit it on the head. You have to work with an agent that knows the different lenders and what they specialize in. And we didn't even talk today about assumables. That's another huge opportunity. You have people that bought right before the COVID rates hit and they got amazing rates and they've actually made some equity in the last few years. And for whatever reason, they have to move. So there's a lot of opportunity in that space too. The key point here is every situation's different. and you gotta align yourself with a great agent and an agent that knows great lenders. And that's really the point, right? It's
Yes,
relationship
absolutely.
business. And that's why you've done, I'm sure, lending, Kevin, for generations of people. And, what a blessing that is, by the way. When I sell homes to grandfathers and grandmothers and mothers and children, that is the ultimate good feeling, isn't it? Just to be able to keep that relationship over the years.
Yeah, it is, because it's legacy. And my mom, who passed away, she was from a different era, right? But she wanted to leave her house free and clear for her kids.
That's
How
right.
cool is that? Because that's
So good.
legacy. It's so good. And we were able to take part of that and bless her memory by being able to dovetail that into buying a place for us. How cool is that? And you can do the same. And folks can, I recommend that if you want to leave a legacy and you live a legacy, invest in real estate, leverage well, and pass that on to your generations to generations to generations. I always say God is in the real estate business. And he is. He absolutely is. And this is tried and true. Anybody that denies it would be crazy, because God is in the real estate business. And so I thought, if God's in the real estate business, I want to be in the real estate business. I also into monkey business too, right? When I have fun, it's like, okay, I want to do that. But real estate is such a great way of building, of acquiring a property and building a nest egg and a legacy for future generations, and on and on and on.
Well, we know he's in the real estate business because in the beginning, God made the heavens and the real estate.
Yeah, he did. He absolutely did.
Yeah.
Not only that, but as you look at it, and we can go crazy on this, but because of people of faith understand that the Holy Spirit, right, hovered over the surface of the waters. How cool is that? I mean,
yeah, it's really cool.
Hovered over the surface of the waters, man. So does that mean the Holy Spirit was a surfer, or walking on water, or what in the world does that mean? Well, the actual terminology is that he was nurturing that. So there's a feminine side to the nature of God in that whole story, which I think is fascinating. And that's a whole nother podcast too, right? But we see that God is in the real estate business. And if that is in fact the case, then there's a clue to us to be successful by dovetailing that with principles that will help us become successful. And real estate is one of those. So not only is it a great place to live, but now you can start buying other places and build wealth. Generational wealth.
Absolutely.
Right?
So friends, this has been a great interview. Kevin, we've hit our time. You've just given us so much good information. Kevin,
Sure.
Tell the audience, how can people get a hold of you? That way they know how to get a hold of Kevin Prince.
Yeah, absolutely. So my company is called The Financial Partners. Thanks for having me. I do so appreciate it. My phone number is 858-926-8904. It's 858-926-8904. My website is kevinprince.net. So that's just information that you can take advantage of and take a look at. And I'm educational in nature. I want people to be educated so that we can walk together. I don't want customers. I want clients. And clients just mean that we run together. And I don't want to do just one transaction with you. I want to be your go-to that will help you through the thick and the thin. If you're having challenges, your credit score is in the tank, you're not making any money, you're whatever the case may be, you're self-employed and you can't prove your income. I love those kind of deals because we can make it happen. When the banks say no, we say yes. And so that's the great part. That is the great part about it, right? Because we can say, you know what? Banks don't understand. I put my K1s in there. They're like, what's a K1? They're like, oh, come on. That's crazy. So with that in mind, I'd love to talk with anybody that's listening to this podcast. I'd love to help you get through the challenges, and I want to earn that business. So I'd be more than happy to walk you through these things, help you with your credit, help you understand your credit, and really help you with homeownership, because that is a beauty of the American dream, right? Because the American dream is still alive. It absolutely is. People's like, oh, no, we can't. No, American dream is not alive. It is absolutely alive, and it's better than ever before, I think.
Thank you, Kevin. What a great interview. I sure appreciate your time today.
Yeah.
Guys, please subscribe to the Jeff Sutherlin Show on YouTube. Let us know how you like these episodes. We keep on bringing you talent like Kevin, everything from mortgage to inspectors to title people to great agents across the country. We are here to serve you. So for that, we just appreciate you listening. Hit us up sometime. Give us a call. Thanks again, Kevin. Appreciate it. Everybody have an amazing day.
Yep. Talk to you soon.